Emerging managers could be very interesting to LPs because historically, we all know that emerging managers have outperformed larger and more established firms. They could, in many cases, offer lower fees or co-investment opportunities. There are a lot of reasons why emerging managers could be really attractive to LPs from an investment perspective.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Diana Tenkova with us. Diana is the founder of Institutional Quality, where they are helping emerging managers with practical fundraising strategies. They offer a range of services from positioning the fund in front of LPs, LP outreach, and closing out the fund. In this episode, Diana shares how important is it for emerging managers to correctly position their fund, how to target the right type of LPs who would be interested in your VC fund, how to build LP avatars, how to build a prospective list of LPs, what's the right way to build relationships with LPs, how to get buy-in from LPs and close out the fund, and so much more. This episode has a wealth of wisdom for emerging managers to set themselves up for a successful fundraise. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Diana, so good to have you on the VC 10X podcast. How are you doing?
Hi Prashant, very good. Thank you for having me. Congratulations on the podcast.
Thank you. Thank you so much. And to start things off, can we first have your background story to start off the conversation?
Absolutely. Yes, I'm Diana Tenkova. I'm the founder of Institutional Quality, where we serve new funds and small specialized investment businesses that want to improve their capital raising capabilities. I moved to Spain 16 years ago, and prior to Institutional Quality, I spent 12 years working for a major international company that organizes private meetings between professional investors and investment managers. So, in my role, after engaging with hundreds of funds of different sizes with a different investment focus within different asset classes, really what was quite obvious was that all of them, whether big or small, they had similar challenges when it comes to capital raising, with the difference that the big companies, the big funds, they have the resources to solve these problems. And the smaller or the new funds, they don't have the same access to solutions, such as, for example, hiring top marketers, building really a very substantial marketing initiatives, branding initiatives, even working with placement agents. There are certain requirements from the good placement agents that some of the small and new funds can't meet. So really realizing this, I towards the end of my career there, I really felt the need that I wanted to help those that were smaller, that were emerging, that were new, because the solutions not always have to be so complex or so costly. Um, so this is why I started institutional quality. Obviously, there are a lot of businesses, and I see, especially lately, that emerge that want to support these managers, which is great. But there is still room for more specialized solutions to assist them, and institutional quality wants to contribute to making the capital raising process a bit less intimidating and hopefully more fun.
Absolutely. That's very important work you're doing there. And that's what this episode is going to be more or less focused on how emerging managers, new managers can raise their first fund. We'll try to focus it on that. So, to start on that front, let's first talk about fund positioning, right? Why is fund positioning so important for emerging managers?
Very important, very important. Um, as a new player, you enter a market where there are already existing funds, there are already existing players. And how you position your fund has a direct impact over who you are being compared to. Yeah. And when you compete for the same piece of capital of a potential investor, this is really really important, because somebody that already has a long track record, somebody that already has a lot of investors, already has an existing and established brand, this makes your job really difficult. I think we can all relate to that. So here the key is specialization and being differentiation. Let me give an extreme example. Let's say you want to be the next BlackRock, or you want to be the next Sequoia. Nothing wrong with that, but you cannot start as a competitor to these kind of firms. You need to offer something in the market that is unique. Your strategy ideally should be very difficult to replicate. Essentially, should not be easily accessible by established managers. And this is directly linked to your particular area of expertise, your particular specialized knowledge. And it's not about the returns that you offer, it's not about the fund terms that you have. This is not your branding. Your branding is really driven by your value add, your specialization, your identity, your story. This is how you position the fund, and it's very, very important.
Absolutely, totally agree. And so there are two types of positioning. One is, of course, the positioning you mentioned that, okay, we are going to target this particular type of company, let's say in a particular geography or a particular segment of companies, a particular sector, maybe, right? So that is one kind of positioning that you can have. And the other is what positioning you have as the GP of the firm, right? Who are you to have the right to win that particular segment, right? How important is that?
Yeah, very important. And again, it comes down to your personal story, your personal area of expertise. Why what you know is not the same as what the big guys know, or what the existing players are doing. It has to be something unique, and sometimes it is challenging for for new funds or emerging managers to really highlight what is it that makes them unique. So this is a very important work that needs to be done in order to highlight that across all communication.
Absolutely. And for emerging managers, they are mostly running blind and trying to figure out what kind of LP might be interested in my fund, right? So, how can new emerging managers figure that out, that who's the right kind of LP they should be targeting, and then reach out to them?
Yeah, so the LP universe is very diverse, starting from close friends and family, to high net worth individuals, to family offices, funds of funds, institutional investors. It's very important to create an investor avatar for your ideal LP. And that's in order to avoid wasting time with potential investors that will never end up investing in your fund. And there are a few aspects you need to consider when creating your investor avatar, and you want to increase obviously the chances of getting a commitment from the engagement with the potential LP. And really, the first question to answer is this a fit? So, looking at your fund size, for example, what are the average tickets that your potential investor normally writes? His minimum tickets, especially if we look at larger institutional investors, their minimum tickets can be too large compared to the overall size of your fund, and therefore it's not a fit because it's too much risk for them, or they wouldn't really consider investing in a fund that has a target size similar to what you have. This is not to say that institutional investors will not invest in a first time fund. Any of the LPs that I mentioned could potentially become an investor of your fund, but it's very important to do the work in advance and to really classify all the potential investors out there, for really who will give you the best chance to get a commitment from. Family offices, for example, we know that they're more flexible when it comes to investing in first-time funds. They could be an ideal LP target, but this doesn't mean that any family office will be a good fit for your fund. Um, so things like, for example, the industry where you invest or the sector that you invest in. If what you do is actually similar to, for example, where the family created their wealth in that particular industry, it gives you a much better chance to resonate with that family office, because they already have experience. They like the sector. They would be keen to support managers in that sector. Or if you don't have the information on the actual families behind, or how the wealth was created, looking into past investments of the family office. Is it in a similar space as yours? This is always a very, very good indication. Looking at fund of funds, for example, as well, that could be another type of LPs that first-time fund managers can approach. But also, it's important to consider what's their investment preference. So looking into previous funds that they have invested in, and also bearing in mind that they go through their own fundraising periods themselves. So timing is important there. If they're about to start raising money for their fund of funds, it might not be the optimum time to engage with them. So that's also another consideration to have in mind.
Yeah, totally. And but all of the things that you mentioned are very spot on, that all this information is important when you are figuring out who is the ideal LP type for you, and also reaching out to LPs at the right time. But a lot of this information on at what stage the LP is in the deployments or what type of investments are they making are often not out in the open, right? So in that case, how do emerging managers figure out what's the investment thesis of this LP? Are they even deploying or not? Tell us about that.
Mm-hmm. Yeah, that's a great question. So there is obviously a lot of information that is not available right away to the public. So this is where it's very important to try and get information from maybe other contacts that you have in common. I know that there has been some great success of GPs that have approached other GPs to ask them for advice, maybe for some insights, and this information is all valuable. But at the same time, there is more information available than we think. So taking the time to really research and dive deeper into news that is out there, or even from the website on information that is available, we can get a lot of information already. And also, I would say for the investor avatar, anyone embarking on a fundraising journey, just take out a pen and paper and create that investor avatar. Is the imaginary ideal investor that you would have, and write down as many details as possible. Anything you could think of, really, where they're based, how big they are, what kind of tickets they would write, would they have previous experience investing in your space, really all the ideal scenarios that you can think of. And from that starting point, if you start building a potential list of LPs that is close to your investor avatar, is really what will save you a lot of time and efforts that will be lost on the way.
Right. I totally agree on that. That's a great approach to doing and building your prospective list. And while you're building that list, is there any public database of LPs with all their not all, but at least a few details listed that this is the investment thesis, this is the focus, and are they deploying or not? Is there any public database that emerging managers can refer to? And if there's not, then how do you figure out which LPs may be interested in you and where to find them,
Mm-hmm.
right?
Yeah, so actually, it's an interesting question because in some countries, it is public information. Not people know that, but within the commercial register of individual countries, for example, in Europe, there are quite a few. A fund that has been raised and closed, they need to disclose who their investors are. So that's a very good way to actually see investors that have committed to similar strategies. And even though there are some free, some public databases, there are a few very good ones available, which are paid, and you can get a lot of very good insights on potential LPs. However, some of them could be quite costly, and there are other places that you need to exhaust first, starting from your existing network. Go through your contacts, who you know that could be open to invest with you, but you haven't approached yet. And also who your existing network could introduce you to. This should be your first step. As an emerging manager, your personal network is your most valuable asset. Only past that stage, you can look into industry events, very powerful, preferably in-person conferences where you can interact with people face to face, but also online events. You can engage with a lot of online events and get to know the participants and connect with the participants and expand essentially your network. It's really any opportunity that you have to connect with your people, with more people, sorry, in your space, is extremely valuable. If you can even get more attention by participating in a panel or a speaking session, this would be a great way to build your reputation and credibility. Um, and when attending such events, it's very important not to just focus on getting to know LPs. Build relationships with anyone in the industry, whether it's an LP, it's a peer GP. Again, personal network is extremely important. And I would say as well, start with your local market. What I mean by that, if you are a fund in Germany, it makes sense that you first explore LPs in Germany, so your local market, before going to France, for example. There are more investors closer to you than you think, and I think the connection is always better when the market is the same.
Absolutely. Totally agree. And once you have figured out a prospective list that, okay, this is my list, these are the people I want to reach out to, then how do you start doing those reach outs? And when you're writing that outreach email, what all information should go in there?
Yeah, it's a very good question, and one that a lot of people struggle with. So first of all, again, you want to try and get as many warm introductions as possible. This is why your personal network is very important. So ask peer GPs if they could introduce you to any of their existing LPs, or if you already have an LP invested in your fund, ask for an introduction to another LP. You'll be surprised how impactful this could be, and I think there are many people that just don't ask. So this is the first and I would say most powerful way to do an outreach to a new LP, if there is a warm introduction. Now, if there isn't any warm introduction, which I guess is what you wanted to ask, then you need to find any common ground to point out in your communication. So your initial outreach should not be about, I have this great product, great investment opportunity that you should look into, and we should have a conversation. It should be about, it makes sense for us to connect because your investment strategy is in line with what we're currently doing. Um, we might have a connection in common. Maybe it's a recent investment that they made, which is very similar to what you're doing, or what you're doing could be a very good complement to what they're already investing in. So anything really you can find that is a reason why you're reaching out to them as opposed to any other LP in the market, is really what the initial outreach should be about. It should be about building a relationship that makes sense, and not about pitching a great fund, which I'm sure you have, but it's not really the ideal reason to connect.
Right. So, do you mean that the first email you should not mention that you're raising a fund at all and just find a common ground and reach out with that and try to get on a call, and then on a call you can potentially tell them you're raising a fund? Is that the approach you're suggesting?
I wouldn't even say on the first call you should be speaking about your fund. We can speak a little bit more about that, but you're building relationships because they have access to a lot of investment opportunities, investment funds out there. It's very important that they connect with people that are meaningful to them. And the people that are meaningful to them are people that have a common ground, that there are synergies within what they're doing, and it will be a value add to the relationship. And this should be your mindset when you approach potential LPs.
Right, absolutely. So relationship building has to come in focus, has to be in your focus, and then eventually the fundraise will happen more organically in that way. And even if they don't invest in you, if the relationship is good, they will potentially introduce you to someone or give you some advice that'll be valuable for you. Right. Awesome.
Exactly.
From the LP perspective, when they are looking at these emails that they're getting from emerging managers, what are the key things they're looking for in them, and how do they evaluate if it's a good fund or not?
Emerging managers could be very interesting to LPs because historically, we all know that emerging managers have outperformed larger and more established firms. They could, in many cases, offer lower fees or co-investment opportunities. There are a lot of reasons why emerging managers could be really attractive to LPs from an investment perspective. But in reality, LPs supporting emerging funds or new funds, they want to support teams that they believe in, that they want to build a long-term relationship with. It's a little bit like a marriage. You're in for at least, on average, 10 years with that manager. So they want to work with people that they like, that they trust as well. So they want to buy into the ambitions and the values that the manager represents. So team experience here is very important, and it should be a fundamental part of the fund presentation, of the pitch as well. Why are you the best person to run this strategy if you're a solo GP? Or what is your relationship with the other team members? Have you worked together in the past? For how long? Why is your ability to find good opportunities in the market better than your competitors? Why are you unique and different? Why should they trust you? Of course, track record is an issue for a lot of these new entrants, new small funds. Even if you're not coming from a big firm, maybe you've done some successful investments as an angel investor. There is a lot that you can actually demonstrate with your personal track record, your personal experience to give comfort to the LPs that you're speaking with. And also, how do you manage risk? Are you outsourcing, for example, your operational infrastructure to a big and established firm who handles your reporting, the legal aspects of your business? These are aspects that show your potential LPs that you're serious about building your fund business. Are you an expert? Here you can really build your credibility and trustworthiness if you position yourself as an expert. And how do you do that? There are many available resources that you can take advantage of. For example, we've seen a lot of success with companies that are placing a lot of importance to education. So running different webinars, for example, that cover topics like opportunities in the market or certain trends or challenges, anything that is really of value and beneficial to potential investors to learn from you as the expert. You can have your own podcast as well, where you can bring other industry leaders and you can be discussing important topics in the market. You can be creating content. You can write white papers. You can have your own blog. So if you're doing that and somebody else isn't, then you're gaining a competitive advantage.
Right, absolutely agree to that. I think that branding aspect is also crucial in helping you stand out from other first time managers, that you are putting in effort into putting yourself out there and in a manner that is getting reached out to people and people are liking that, right? So that's always a plus from the LP perspective, right? Awesome. And when these conversations start flowing, that you have done the first meeting with an LP, but then once the first meeting is done, the conversation runs dry, let's say, right? What do you do then? How do you run the follow-ups? And if you're writing a follow-up email, what should you write there? Is it just like, okay, pumping this up, wanted to check if there's an update, right? Or something more to that? And then how frequently, how often should you run those follow-ups?
Yeah, yeah. This is a major issue for a lot of managers, emerging or not. Um, there isn't really a universal solution to re-engage investors that have stopped communicating with you. Sorry to disappoint the audience, but the first question to answer is why did this happen? It's okay to send a few follow-up messages as we all get busy, but if there is no response, there is something more behind this than just what you said or how you said it. So I would say here the most important message that I want to give to your audience is the prevention of the situation, because once this happens, it is challenging to revert. So when you are speaking to a potential investor, or you're meeting with a potential investor, by the end of the conversation, ideally you should agree upon what the next steps will be. You should always have this on the back of your mind and keep control of what the process will be. Is there going to be a follow-up meeting? Is there going to be maybe meeting with another partner within the LP organization? You really want to find out what would the next step be and agree with the investor whilst you're speaking to them on the next steps. This allows you to really keep control of the follow-up process. Um, Setting clear expectations, that's what I would say is very, very important. Another factor that may cause a conversation to run dry, if let's say an investor is asking for a specific piece of information that you don't have ready to go. What happens there is that you take days, sometimes could be weeks, in preparing something for that investor before you're able to send it. And what happens is that the interest goes down, um, and then the investor might get as well slower in their response time. So one advice here will be, before you engage in any LP conversations, have your materials ready to go, so there are no further delays. And I'm not just speaking about the fund deck. I assume, is the first material that your audience will have ready and prepared. But there are additional materials that an investor could ask for. You can have a separate document, for example, with more expanded information on your track record, maybe a list of previous deals that you've made, a one-pager, any references, investment memorandums, etc. I would strongly recommend, if needed, use a third party to help you prepare all the documentation, and then have it centralized and have it ready to go whenever somebody requests it. And again, it's also part of the process to let people know that it's okay for them to say no. If for whatever reason they don't see a fit, let them know. You're totally fine with getting a no. You would actually appreciate that. So you don't lose time in chasing someone who might have decided that it's not an interest. It's not of interest to them. Professional investors normally they would take a time and they would write an email saying it's not a fit for now. Hopefully they can give you the reasons why. But if you let them know in advance, you're more than okay with getting a no. It will save a lot of time.
Absolutely. That's such an holistic answer to the entire question on what to do if a conversation runs dry, and what to do to prevent that situation, right? From controlling the entire follow process by setting the right expectations, all the way to being open to a no as well and communicating that as well. Awesome insights here. So when an emerging manager has some commitments, maybe a lead LP is there and they're looking to close out the fund, right? How do they build momentum and get buy-in from all the LPs involved?
It's a great question. Um, I would say it's easier to build momentum with a smaller fund. Even if the majority of the funds that invest in your space are in the hundreds of millions of AUM range, and really the market potential could be really big. Raising first fund that is small, this doesn't mean that you have to stay in that range. It's you starting. So if you come up with a big target, the investors that you speak to, they know it will take you a long time to reach your close. So they will rather wait and see who else had invested before they make a decision. And it's a completely different mindset when we speak about small funds because the target is more realistic. Psychologically, the investors know that you might be able to raise that fund relatively quickly and will give them that little extra push to actually act and invest. So it's important that once you have that first investor, and as you said, keeping the momentum, you should be providing updates on a quarterly basis. You can create your newsletter as well that you can share with your potential LPs on a monthly basis. Anything really to show your progress, or in case you've made already some investments from your fund. At the end of the day, it's important to keep yourself on the top of the mind of the LPs that you are engaging with. As well, you can use different incentives to get investors to commit early. Could be a reduced management fee, could be co-investment rights. Again, your first fund is very important for you to get yourself out there, get those first investors, get those first deals done. And then your job will be so much easier with obviously your follow-up funds, because I'm sure you're here for the long term.
Totally. Yeah, great insights there again. And now let's talk about, so there are some funds that do multiple closes within a fund, right? Do you think that's a good approach?
I think so, especially for emerging managers, because it's a way to demonstrate that momentum, um, and it's also a way, for example, to get investors that may have been a bit more hesitant first time around to commit. When they see you've done a first closing and you already have other investors that have committed, this is a very positive sign for them, and will probably incentivize them to invest. And obviously, it shows progress. So it is a very good strategy, and also for you to be able to, in case you had no previous track record, to actually make some investments and then already demonstrate what you've done after an initial close.
Right, absolutely. And let's also talk about the call, the LP meeting, right? So once you get on that call, are there any best practices that you can share for the first LP meeting that you have?
Yeah, so this is going back to, I think, a point that we discussed earlier. Um, the first meeting, and I've seen that a lot of managers or new funds think of it as, I need to fit everything, all the information in that first meeting. So hopefully I'll get the interest from the investor, where actually it's completely the other way around. Um, the first meeting starts, first of all, with a mindset. I see too many new funds that start a meeting with um, too much of a thank you for the time and thank you for the opportunity. And I think obviously it's good to show respect to a potential investor, but um, you don't need to create an environment where you are in a desperate situation, asking for their capital. It's an opportunity for you to present who you are, absolutely, but it's also an opportunity for them to learn about what you do. So it should be equal. And then a lot of fund managers spend that typically 30 minutes for an initial meeting, just going through their presentation. They will share a screen, and they will go over slides, which obviously prevents them from learning more about the investor, finding out what that common ground would be, where the fit is, learning about the investor, investment preferences, ideally some concerns that the investor may have, so they can specifically address those. A presentation you can always send after the call. It's very important on the first meeting to spend as much time as possible asking questions and getting information from the investor and building that connection, that relationship. And really, the objective of the first call is not to sell the fund. The objective of the first call is to establish there is a fit, and to have a second follow-up call or meeting where you have the opportunity to then speak about your fund in more details, once you have that green light from the investor that they are actually interested to learn more.
Absolutely. Yeah, that's a great advice there. So basically, it should be focused on, but I think LPs would ask you to pitch on the call. So what you're suggesting is you don't share a deck and start pitching. Instead, you start a conversation, pitch yourself because you know what the fund is about, you know yourself, right? So make a quick pitch and then tackle the objections they might have or the questions they might have, and then ask your questions as well. That might be the best utilization of the first call. Yep.
I would say before you get into details on your firm and your fund, be curious about
Right.
them. I'm not saying
Right.
ignore questions that they ask you about your fund, but this initial
Right.
call should be the start of a relationship. So that initial conversation is about you also finding out, is this an investor that is a fit for you, and they also want to find out, is your fund a good opportunity for them, but most importantly, you as the manager or the team or the story, do they like what you do? um, And then if you at some point want to show some information, obviously that's um, very easy to do. You can follow up with the material. You can maybe pull out a slide maybe to show something. But um, what I see too many people do, and it's not really successful, is from the very beginning they open a presentation, they spend the entire time in going through slides, and then at the end they haven't really had the opportunity to learn anything new from the investor, and then they're a bit lost as well with another issue that we discussed, which is the follow-up. But that's because they did not understand from the initial meeting how does this fit, and is this going anywhere, and which area they should focus more on working with that investor.
Yes, absolutely. Great insights there. And to close this out, can you tell us more about what is institutional quality and how you're working with emerging managers and helping them raise their funds?
Yeah, so precisely these are some tweaks to what a lot of people think, it's how they should approach capital raising. But these are not solutions that are very difficult to implement. We want to work with clients as an extension of their team. A lot of these managers, again, don't have the resources to really hire a top marketer or have a big sales army in their company. So we want to be that partner that will assist them with creating these strategies, really making those little tweaks, um, and and help them navigate that process, which again doesn't need to be so scary or so unpleasant. Building the relationships and not so much selling the financials. They will have more fun in the process.
Absolutely. Thanks so much for sharing that. There's been an incredible episode filled with insights for first time managers. I'm sure our listeners would appreciate it. And to just close this out, can you tell us where can our listeners follow you and maybe learn more about institutional quality?
Yeah, so we are mainly active on LinkedIn. We from time to time share some insights in terms of strategies and specific tips that we would like people to have access to. And yeah, for us it's important as well to build relationships with funds that are starting out and need that extra level of understanding of, of the psychology behind a little bit around how to approach it. And the majority of the funds that we work with are just brilliant when it comes to how they select the investments. They're brilliant investment people and minds, but sometimes they need that little help when it comes to the capital raising aspect.
Absolutely. Yeah, that's very valuable for emerging managers who are trying to figure out almost in blind how to do the capital raise, especially when they're not familiar with it, right? So that's of great help to them. I'll make sure to put the links in the show notes and description below so that our listeners can get there easily. Thanks so much, Diana, for making time for this and sharing your valuable insights on fundraising for emerging fund managers. Thank you.
Thank you, Prashant. It was a pleasure.
Thank you so much.